Hi, this is Keith Singer of Singer Wealth. If you have money invested in the stock market, then you probably have one of three things. You either have mutual funds, a separately managed account, or you pick your own stocks, or you have indexes. Now, if you have indexes, you're just trying to get what the market gets. And that's actually going to beat 85% of money managers. If you have mutual funds, or you're buying your own stocks, or managers buying your own stocks, you're trying to beat the market. And if you are a manager, or you're working with someone that can beat the market by 1 or 2% a year, you're considered a rock star as a manager. It's very, very hard to beat the market. However, there is a strategy that even the average investor that doesn't know anything can be guaranteed contractually to beat the market, and that is structured growth notes issued by major banks like JP Morgan and Morgan Stanley and Goldman Sachs. And these use stock indexes with leverage and also downside protection. So for instance, in 2000, the market was pretty low in March, so we were looking for a way to catch a rebound. So we had Citibank issue a note that gave us 163% of the Dow Jones index or the S&P 500 index, whichever one did worse. And so a $75,000 investment 4 years later matured for $188,000. Okay, that's because we made 63% more than the Dow Jones did recovering from COVID. And so if you could beat the market by 20%, 30%, or 50%, that's pretty amazing. However, right now, there are structured notes where for 6 years, you're guaranteed contractually to beat the S&P 500 Futures Excess Return Index by double, right? So if it makes 50%, you make 100. Plus, at the end of 6 years, if the market's down, the first 20% you don't lose. So we got less risk, more reward. Now, the S&P 500 Futures Excess Return Index is highly correlated to the S&P 500 Index. In a nutshell, the last 5 years, according to Citibank, I think the S&P 500 was up 13.79, and the Excess Futures Return S&P 500 Index was up 12.7. And so it lost by about 1% a year. But if you're making double the returns of that 12.7, you're actually making 25 compared to the S&P 500's 13.79. So you're really beating it by a lot with some downside protection. Now, if you want to go longer, we are about to do a note for 10 years. And if you think about it, any money that's invested in the stock market should be long-term money. That's going to give you 2.8 times the return of the S&P 500 Excess Futures Return Index. Now, you can sell the note before 10 years. You can sell it after 1 year or 2 years or 5 years. You may not get the full intrinsic value, but it is sellable just like a bond. So if you're looking to be a buy and hold investor, but you want to do better than the market while taking less risk or equal risk, obviously you're going to have the credit risk of the issuing bank, so you're going to have to hope that JP Morgan or Citibank is still in business. But I would suggest to you that if JP Morgan's out of business, the stock market as a whole isn't going to do very well anyway. And so if you want to beat the market, guaranteed contractually over the next 5, 6, 10 years by 2 or 2.5 or 300%, then that's something that you should consider. Why not have something that can beat the market by so much with not taking any more risk? Because we're trying to grow our money with as little risk as possible. So if that's something that's of interest to you, call us at 866-WEALTHY or email me at keith@singerwealth.com.